All right, so S. Carter says, I am in the options masterclass and I'd like to know the following. If I write a covered call on a strike, is it ever wise to take the hit? If the stock skyrockets past the strike, is it ever wise to take a hit and buy your callback in favor of market appreciation? I heard that the premium on writing calls helps to lower your tax basis. Are you familiar with this as a tax strategy? First off, let's start with the first question. First of all, anybody who doesn't know about options and how they work, if you go to blackoptionsinvesting.com, that's blackoptionsinvesting.com. There's stuff there. Also, we have a stock options masterclass that I did over a 6-week period, and the recordings are available, so feel free to go take a look at that. The thing about writing a covered call is you do have that chance that the stock could go past the strike price, and it may happen long before you hit the expiration date. So if that occurs, and you do decide to go ahead and buy the option back, you're not just going to pay the intrinsic value, you're going to pay the time premium. But, if you bought it back and then sold another option right afterward, well, you're going to get that time premium back anyway because you're going to be selling another option. So it's kind of a wash. Now, in terms of the tax basis issue, I guess it could help your tax basis because it would magnify your loss. So if you're putting out that money and you're buying the option back and you had a net loss on the trade, then that would make a bigger loss, which would make a bigger, which would help your tax bill. But I'm not a person who does that based on tax situations. I just do it based on what I think is going to make the most money in the next move. So I hope that helps you. But generally speaking, I think it's okay to buy options back if you feel the need to hold the stock or free it up so you can sell another option. The thing I like about writing calls is that it's a great way to generate income on a portfolio without having to sell your stock. So sometimes you need more income, sometimes you need a little more money. So the type of option you sell on those shares that you own will determine how much income you have for that month. But it does, your risk will shift as your income decision changes. So good luck. And I buy them back all the time, before the expiration date. I pay the time premium because, like I said, usually I'm going to sell it right back, just maybe at a different expiration date, and I'm going to get that time premium right back. So it's not like it's gone. So I hope that helps. Take care. Bye-bye.